Hi, I'm Hunter Hutt, Director of Business Development, and I'm here with Andrew Torres, CEO and founding partner of Lawrence Park Asset Management. Today we're here to discuss the recent performance and opportunity set in the CI Lawrence Park Alternative Investment Grade Credit Fund. Although September was a soft month for risk assets, our fund was positive and was first quartile over the month and over the quarter. Andrew, congratulations on the strong performance. Do you mind highlighting some of the contributors to the performance for the quarter?
Yeah, it was a great quarter for the fund in general. In looking at the sources of performance, it's important to look at two things. First of all, we build this core portfolio of yielding investment grade assets, and we utilize leverage in order to boost that return that we get from the carry in those assets. And we saw continued recovery in these short dated investment grade bonds, which had become severely dislocated through the spring pandemic and have continued to recover value. And then secondly, we also have this active trading strategy, which is being buoyed by a very, very strong new issue market in corporate credit. So we are constantly participating in these new issues as they come. They generally come at a discount to market, which means that there tends to be some near-term mark-to-market gain. And we can actively trade that for ongoing continued performance. So whether markets are having a strong month, as they did in July and August, or having a soft month as they did in September, this active management and active rotation combined with very, very short dated assets that are constantly pulling to par as they move to maturity, those continue to generate good core performance for the fund, and we're able to continually achieve positive performance regardless of market conditions.
Thanks, Andrew. Do you mind highlighting some of the key components of the portfolio structure and how you're setting up the portfolio going into the fall?
So we're obviously, with what's happened in recent weeks, we're seeing some resurgence of pandemic fears. We're well into election season in the US. So there's a number of uncertainties to come. We still remain very constructive on investment grade credit generally. That's based on the premise that so long as these high quality companies can continue to operate, even if they're not thriving and boosting their equity performance, that their credit component should still do fine. So we've set up the portfolio to be relatively conservative, but also constructive. We're overweight in Canadian dollar bonds, which we think have less uncertainty because of the lack of any election up here, better coronavirus statistics generally. And we've also implemented a hedge overlay strategy where we're using options on credit indices to stem from any potential downdraft that we might get. So we feel the portfolio is set up to perform. We still got good core yield, but we're also protected, we think, against any downside risk that may happen.
Amazing. Do you mind giving us a 30-second overview of why now is the time to invest in the CI Lawrence Park Alternative Investment Grade Credit Fund?
Yeah, the landscape for fixed income investing is getting more and more difficult. If you think about the traditional options, you've got duration-based fixed income, which it's getting harder and harder to make a case that that's really going to perform when you need it most, which is when other risk assets are falling. Certainly in September, we saw as much as a 10% drop at one point in major market equity indices, and treasuries and government of Canada bonds really did nothing. So they really were not contributing. On the other hand, you've got high yield, which is fine so long as markets are moving in one direction, but they're the first to drop if we really get any kind of market shock event. So in the context of that, you've really got an alternative fixed income strategy, which is not rooted in duration, and it's not rooted in taking excess risk through high yield. We stick with core, short-dated, high-quality investment-grade bonds, and we actively trade them to generate return. And in this kind of environment, I think that slow and steady down the middle approach will hold up very well in investors' portfolios.
Thanks, Andrew. If you'd like to learn more about our mandates or have any further questions, please reach out to our team. Thank you and stay safe.